Good afternoon and welcome to another VSA Capital Technology and Transitional Energy podcast with myself, Phil Smith. And this week we have a special guest as Andrew Monk, our CEO, is away traveling this week. But my guest on the podcast is Richard Coffer from our corporate finance department. And Richard, how
Good
are you?
afternoon, Phil.
So, Richard?
Good afternoon. Thank you for that introduction.
My
special guest is probably somewhat overdoing it, but very nice to be here and join you, Phil. And shall I jump straight to it then?
That would be excellent, Richard. Go for it.
Excellent. Well, we've just had moments ago the ECB put out a decision increasing rates by 0.25%. And so, interestingly, in terms of talking about the macro, I think this week, disinflation still remains intact. So Eurozone inflation this week was announced at 7% in April from 6.9% in March. So it's remained fairly steady. We've seen the Eurozone putting up 0.25% just now, so that should steady the ship. We've seen UK's core inflation. This is inflation which removes volatile food and energy prices. That ticked a little better. That was down for the first time in 10 months, Phil. So that's now at 5.6% in April from 5.7% in March. So the mood music's starting to feel marginally better. We've seen some supply chain bottlenecks appear to be freeing up. Import prices appear to be receding. So the general mood music is slightly better than it has been. However, the task is still an enormous one for these central banks and more onerous than ever, really. They've still got to reduce inflation. At the same time, they've got to guard financial stability and protect anemic growth. So they've definitely got their work cut out. And this is all without being quite sure how far existing rate hikes have already filtered through into the economy. So I think it's an interesting time. The picture's still very, very mixed. But the focus from central banks remains on returning inflation to its target rates. And we've got follow-on meetings next month where we can expect the Fed to also raise rates by 25 basis points. So, we're still in the cycle where rates are going up, but we're hoping that they're coming to peak soon with the expectation that the ECB interest rates peak at 3.5% to 4%. In terms of earnings, Bill, well, Q4 last year was horrific for US earnings, and they've been punished more severely, those that issued profit warnings, than any time since at least the turn of the millennium, according to the Financial Times. So 2 quarters later, and the earnings scorecard is definitely up to a better start. But there is, as ever, a however, which is that both the number of companies reporting positive upgrades and the magnitude of those upgrades are still below their 5-year averages. So life remains tough. In terms of recent Q2 earnings, 28 S&P 500 companies issued a profit warning, whereas 20 managed to issue upgrades. So where does that bring us out in terms of valuation? Well, PE multiples 12 months forward is at 18.1 times. So that's below the 5-year average of 8.5, but it's still above the 10-year average of 17.3. So given the economic backdrop, it's sort of fully priced, I would argue, on those sorts of multiples, fair to fully priced. It doesn't feel benign enough to justify anything more than that. One of the things I did notice, Bill, quite interestingly, was that Apple issued its Q2 earnings last night, and they've spent $572 billion on buybacks since 2012. And a quick back of the envelope calculation, that's the combined market cap of the FTSE 250 today. So that's awesome numbers. I just thought I'd sort of round off really. In dispatches, I thought it was worth referencing the FCA proposed some rules to simplify the IPO process. I don't know if anybody's come across this. They're now creating a new category of listing called the innovative issuers, and they'll be able to you won't have to be necessarily profitable. There'll be dual class structures. This new category will also have a lower free float. You won't need 25% anymore. The minimum float will now be 10%. Moreover, and for a corporate financer like me, I won't have to issue a prospectus if you're raising money from institutions. So that's definitely most welcome. So I think these are interesting developments. However, we have seen something similar to this before, Phil. I think you're old enough to remember back in 2013, the LSE created something called the high growth segment with a similar idea of attracting high growth businesses and technology. You didn't want to dilute down and issue more than 25% plus of its issue set capital. But having already seen this before in 2013 with this high growth segment, 5 companies listed on that segment, and it lasted up until 2018. So that was 1 a year. And none of the companies that did list on this high growth segment was sort of well-known technology names, unicorns, household names. So I query, whilst I welcome these changes, I personally remain unconvinced that this will make any meaningful difference in terms of seeing a return to the IPO market. And I think until government, FCA start addressing equity allocations, the speed and cost of an IPO versus private equity, the fact that private equity returns are reduced by leverage and a tax incentive regime, it's not entirely obvious to me, at least, until some of these bigger issues are addressed, why one would necessarily opt for an IPO over private equity. And I think more needs to be done to level the playing field if we want to see a decent return to the public markets. So I'll draw stumps there, Phil, get off my hobby horse, and I'll hand over to you, Phil, for the company news.
Well, Richard, thank you for that. There's nothing wrong with having a hobby horse, and as Andrew and I have discussed on many occasions on this podcast, anything that makes it, opens up the public markets a lot more and makes it easier for companies to raise capital in the UK and helps us to have the sort of, tech investing environment they have in the States would be very, very welcome. But thank you very much, Richard, for those inputs. What I'll do this week, I'm just going to go through some of the US results and then UK company specific, and with a focus on sort of end sectors, because we're very much here focused on sort of economic drivers and drivers of spend, because ultimately, that feeds through to companies in the tech and transitional energy sectors and their share prices. And one that caught my eye, this is on industrials, and we've been looking at industrial spend, and this is a company called Hexagon, and they are a large global supplier of industrial instrumentation, particularly measurement positioning systems and software. And they reported their first quarter results, and they have been managing cost inflation in their supply chain, currency movements. But they said their operating profits were in at 372 million euros against the year earlier of 335 million euros, an organic sales growth of 8%. So there's a good, strong set of results there and reflecting industrial spend, and also maintaining strong operating profit margins of 29%. And keeping with industrials and companies with technologies into the industrial markets, Emerson, again, big global multinational, and they supply all sorts of industrial equipment, so valves, actuators, controls, safety measurement instrumentation, software for digital operations management. So their Emerson kit technology is used across automotive, chemicals, power generation, a whole range of industries. And again, they had their first quarter results, and they raised their 2023 outlook and reported better than expected quarterly earnings. And this is on strong demand, according to Reuters, for their automation systems and in a tight labour market. So again, like Hexagon, reflecting continuing business spend on equipment into the industrial sector. Now, an area where spend has definitely been weaker, as we know, we talk about, is in consumer electronics. Particularly, we've seen the PC market hit. I mean, IDC, I saw figures from them expecting it to be down something like 30% first quarter this year. We had poor results from AMD, the chip company, into the computer market, so hopefully improving. But we saw results this week from chip maker Qualcomm, and they're a big supplier into the smartphone market, and they're saying that the smartphone industry is going to take longer to use excess chips. This is on inventories because obviously people built up inventory during COVID as there was high demand, but smartphone demand has remained weak overall. And according to Canalys, this market research group, they're expecting shipments to fall 13% this quarter. So consumer electronics results coming through, continuing to be a bit weaker there. Apple, I think we do have actually reporting as well. I think that's to come through though. Richard, you made a comment on that. But moving on from consumer electronics onto automotive. Now, again, automotive is, cars are big ticket consumer spend. So again, we're watching this very closely to see what's happening within the economy and getting a feel of what's coming ahead. But remember that it's a bit of a confusing picture because the automotive makers have been catching up. The supply chains have been catching up with their demand. They've not been able to get their silicon chips to build the cars. So now supply chains are easing, as Rich commented on earlier, and they are building and getting growth in volume. So VW, one of the biggest in the world, has just reported its first quarter. It's seen a 22% rise in revenues, and car sales rose by 6.5% to 2.1 million units. Now, what is interesting is we're in May and VW are maintaining its targets for 2023 and expecting deliveries to rise by 15% to 9.5 million overall. So it's expecting strong demand to continue. And what is also very interesting for us and in the tech sector is what is happening in EVs, because obviously EVs are going to be a big drive for tech going forward. They were 7% of VW's sales, and they have said it is seeing higher competition in the market. So this is something that Andrew and I spoke about in the last couple of weeks, how we're seeing a lot more competition coming from China, and also quite a bit of price pressure, and that can feed through as well. But they are, expected to stick to their profit guidance, but they're seeing intensified competition. And we saw a similar result from Ford as well. Very strong sales, more competition in EV. It had, it's developing its own electric motors, Ford, and it's taking a hit on losses there. And it's being supported by its petrol vehicles at the moment and saw strong overall results. But it's expecting to move its EV division into profit. I think that was in 2026 I read, but they're seeing the profitability recover there, but again reporting price pressure. So we'll keep a close eye on that, because what happens in EV knocks through to a whole load of areas in technology. Staying with automotive, this is Infineon, another chip maker, and they're Germany based. Infineon have been around for many years, but they're a big supplier into the automotive sector, but also renewable energy generation and energy infrastructure. And they reported raising their full-year guidance and outlook with strong demand from EV, electric motors, renewable energy, and energy infrastructure, which is very encouraging. And they said they're expecting full-year revenues of 16.2 billion euros against the previous forecast of 15.5. So they've raised their expectations there on strong demand from those sectors. So that is all quite positive, but you've got to remember as well, you've got to watch these results closely because they are a chip maker. Chip supply has been constrained into automotive. Now it's easing up, and of course they're benefiting from that as supply chains are easing and into the auto industry. So that was sort of more generically across the sector. So still seeing strong demand in automotive despite consumer pressures. A lot of investment going into EVs, which is all good news, but also strong demand from industrial. So we're not seeing any businesses, or don't see, right now in the industrial space, but cutting capital expenditure in a big way. And if the economy really suffers, you will see them cut. So we're not seeing that coming through. Just quickly onto the UK, and some specific results were quoted here. One that Andrew and I have discussed quite a bit, which is Computer Centre. Ticker is CCC, 3.6 billion market cap. Shares are up 22% year to date. Now, Computer Centre is a really interesting stock. The guys have been quoted for a good number of years, long track record here of generating profits. And they're a big supplier to business of technology resource. Now, that can either be tech equipment, computers, networking, security, or software that's related to that, or outsource IT support and IT services. And they said that strong growth experience through 2022 has continued into the first quarter of this year, which is good news. They're managing their margins. They're seeing some challenges in margins. I guess they've got quite a bit of inflationary cost in there, but they are managing that. They're seeing a return to seasonal normality. And they're expecting growth in profitability both in the first half of this year as well as for the year as a whole. So that was quite a good outlook from them. They said customer demand remains strong despite economic headwinds. So they're not seeing their customers cut spending at all. Now, this is one I've not come across before, Richard, and it's a company called Ashtead Technology. The ticker is ATAS. The market cap's 293 million. They reported their full year results. And this company is equipment rental, but it's equipment rental into a highly specialist area. It's equipment rental into underwater, into underwater. It's underwater technologies and support services. So it's a global offshore energy sector is a big driver for their business. So they have three core businesses: that's surveying and robotics, mechanical solutions, and asset integrity. I mean, it's all about going underwater, installing wind turbines, oil rigs, whatever it is that's subsea, for installation, inspection, maintenance, repair, decommissioning of infrastructure. So it's all about offshore energy. They reported revenue up by 31% to 73.1 million, and organic growth with an acquisition in there. But organic growth, get this, was 23.7%. So strong growth there. Probably a lot of this due to recovery in offshore oil and gas. We've seen those markets come back post-COVID, and it said here that it's driven by renewables and indeed offshore oil and gas. And gross profits up by 34%, so revenues up 31, gross profits up by 34, and filtering through the profits, EBITDA up 47% to 20.1 million on sales of 73.1. So first time I've had a look at this one, and that is one very good set of results. That's Ashtead Technology, ticker is ATAS. And I guess the final one from me, and again, this is one we've looked at before, and this is Zoo Digital. Really interesting. This the ticker is ZOO. The market cap's 134 million pounds, and Zoo provides what are called cloud-based localization of media services to global entertainment industry. Well, that's quite a chunky off description, but basically, Richard, I'm sure you've heard of Netflix, but Netflix have there's a massive content offering of programs that aren't in English, and particularly programs that are in Spanish, be it films, be it TV programs. But all these programs often have to be dubbed or localized, depending on where the market is. So they may be produced in Spain, Portugal, wherever, but they have to be dubbed for the local markets and translated. And this is what their software and their services does. And they just commented today they've made a small acquisition, a company called AM Group, and they are basically going to act as a hub for Zoo's operations in Spain and Portugal. And AM Group have got facilities in Madrid and Valencia, recording studios, control rooms, mixing rooms. So this is going to help expand their offering for Spanish programming. And they've noted here that Netflix launched in Madrid in 2019. So very interesting acquisition for them. I have Spanish connections in my family, and I certainly know how much demand there is for Netflix's Spanish offering and how broad that sort of thing is. So Zoo have made that. And interesting to look at this is forecast from Icon. This is analyst forecast, and for revenue of 94 million the year in March in this year, raising to 110 million, and net income to go up from 6 million pounds to I think it's about 9 million, but it's on a PE of 30 times falling to 19 times. And Zoo raised money earlier this year in April. They raised 12.5 million pounds to provide funding. That was at £1.60. The share price is now 1.49, but it's an interesting company now. It's got some good drivers behind it. That's Zoo Digital. That's ZOO. So we've been a bit thin on results this week, Richard. We've had a bit of bank holiday for us all to enjoy, but there we are. And Richard, thank you very much for guesting with me this week. And thank you for your inputs, and I hope you're able to do that again. And I'd finally like to suggest, as Andrew always does at the end of our podcast, is that if any of our listeners have got any suggestions, then do write in and let us know. Or if you think we've missed anything, write in and let us know. We're always very grateful to hear from you. And we look forward to doing another podcast at the same time next week.